Welcome to LaTour Retirement Talk. I'm your co-host, Tony Shore, and I am right here. Look at you guys, Jim and Josh, Jim Margraf and Josh LaTour. They're our hosts for the show today, as always, and I know they have a great one lined up because, wow, again, a huge get. When you guys have guests on the show, I'm always impressed. This guy, probably walking straight over from the Fox Business or CNBC recording and taping to be on your show. A senior portfolio manager over at Gradient Investments. So I'll let you guys introduce him. But first, how are you guys doing? Jim Margraf, what's going on over there?
Oh, not too much out of the ordinary for me, Tony. Enjoying some of our fall weather here.
Sure.
And, finally got out of the shorts and T-shirts and, starting to wear the sweatshirts and the warmer jackets. I mean, so, it's been, it was a little bit unseasonably warm here for us through the early part of the fall. But, just enjoying life and having fun.
Yeah. Speaking of having fun, look at him, Josh LaTour, just sitting there, loving life, living large. Josh, how have you been?
I've been fantastic. I'm looking forward to this weekend. Going to go to spend some time with my sister and brother-in-law and my niece and nephew. Have a really nice time with them. So
good. Well, why don't you guys introduce our special guest so we can jump into our topic for today?
All right. So we have a special guest with us today named Keith Gangl. So we work with Gradient Investments to they provide the portfolios that we use to help our clients. And Keith is the senior portfolio manager at Gradient Investments, and we're pretty proud of him over there. And he's been one that brings several decades of experience in the institutional fund management to the team. And one of the things we're pretty proud of is he's won several awards as a portfolio manager with the team that he worked on prior to Gradient. So pretty proud that we've stolen him from where he was before and gotten him over here at Gradient Investments. So, while he's been working here, he's been promoted to the senior portfolio manager here in the not too distant past. So always proud of that. So Keith, welcome to the show here at LaTour Retirement Talk.
Welcome. Thanks, you guys. You guys are awesome. You're great to partner with. So thanks for all the nice words you said and love the show. I was telling Tony, long time listener, first time participant. So I'm on the show. Thanks, guys.
Yeah, well, we've been talking about it now for the last couple months. Jim and I go back and forth like we need to get a hold of Keith and get him on here, and then something comes up and we forget to call you. So we finally made it happen this last week.
You didn't lose my number this week. I'm glad. So this should be a good show.
Yes.
Yeah. So Keith, we got a lot going on right now. I mean, there's government shutdown. We've got the Fed messing with the interest rate. We've got tariffs. A lot's going on in America right now. Why don't we kind of go through a brief synopsis of where we've been so far this year, where we're at now, what are we looking like going forward?
Sure, I'll give you a little review of the market. Obviously this year's been pretty volatile. I mean, if everybody remembers back not too long ago, just back in April when Liberation Day was announced, April 2nd, markets were up about 5-6% going into that. Liberation Day, like I tell Tony all the time, I think it liberated everybody from their wallets for a little bit. The market,
right?
Markets almost went down 20%. I think everybody started to get comfortable with the new tariffs, kind of what they're going to do, hopefully what they achieve. And now we're setting all-time highs in the markets. Markets year to date, when I say markets, I'm referring to the S&P 500. We're almost up, it depends on the day, 16, 17%. So fantastic year after the previous 2 years of, 26 and 25%. So that's a nice almost 3-year run in the market. So things have been good. And part of the reason the market's been so good, obviously they kind of looking past these tariffs and kind of hopefully they maybe bring some good things, but earnings have been exceptional for this year. They've been great. We're about week 2 of 3 in what we call earnings season, and they've been fantastic. So about 2/3 of the companies reported. They've been pretty solid. I'm sure we'll get in a little more discussion there, but we've had that. We've had the government shutdown. As of the recording, we're shut down for a month. So we'll see. That's something I'm keeping my eye on as well, because if this drags on too long, that'll be a little more uncertainty, a little less government data. That happens. I think investors could maybe, after this nice big run we've had in the market, maybe pull back a little bit, get Which again, market corrections are normal; they happen. So it's
Mhm.
not to be unexpected. And again, after this point in the year, maybe we are due for a little bit of a correction. But that being said, I still very positive going into year end and next year.
So even with a correction, that of course they're normal and they happen all the time. We still think that we'll finish the year positive.
Yeah, exactly. I think we grind a little higher from these levels here, and corrections are normal. You guys do a good job of diversifying your clients. You put them in different asset classes. So when you do feel these corrections,
Right.
they're a little more muted, which is
Mhm.
awesome.
Right.
And again, so you allow some participation as well on the upside. So you guys do a fantastic job working with the clients. So I do think right now, as of like I said, 2/3 of the companies reported their earnings. We've had this week was a very big week. This was kind of the mega cap tech earnings. And I was
Mhm.
saying going into this week, this week would determine kind of how the rest of the year goes. And for the most part, those earnings were really good. So
Right.
Meta was a little bit soft. But other than that, most of them were
Mhm.
fairly positive. So I think that AI investment, which we didn't touch on, that's another driver all year long, has been this investment in AI, these large cap technology names moving the market. Now, at some point in time, the market's going to start broadening out, which is a good thing.
Right.
But for
Right.
now, that's a key driver for the overall markets going forward.
Yeah, I know that just for a little while here, the market's been pretty concentrated, so much so they've gotten the nickname of the Magnificent Seven,
Right.
right? And I was looking the other day, it seems to have broadened a little bit from being so concentrated on those guys. But as far as those guys are, how are they doing as companies? As because they are with them being such a large
Yeah,
part of the market,
Right.
that what happens with them really does affect everything. So
for sure. So of those top 10, just to put in perspective, the top 10
right.
outside the Meg 7 as well, the next couple names,
Mhm.
that makes up about 40% of the
Right.
market, the S&P
Right.
500.
Wow.
That's the highest it's ever been. So
Right.
that just alone makes me a little bit nervous.
Sure.
But the reason that they're so big is just because their earnings power has been so strong. It's
Right.
right now earnings season, like I said, we're two-thirds of the way through it. I think we had 6 of those Meg 7 report, or
Mhm.
yeah, 6 of the 7, and it's been good. I mean, they're on average over 20% earnings growth.
Mhm.
That's really good. So
That's huge.
that's huge. Just put that in perspective. We always talk about historical. So if you get earnings, for the full year of 6 to 7%, that's a very good year. That's usually a nice tailwind for the markets. This year, the way it's looking, earnings been better. So right now, I think Q3 is kind of about 12% earnings growth. That's fantastic. That's going to take the full year above 10%. So it's
Mhm.
about that long-term average 6 to 7. But then next year numbers are on 13%. I think that's a little too high, but if it's
Mhm.
anywhere near 13%, that's that backdrop for a positive market next year. I think it's going to be more normalized, after we've had, 26, 25, wherever this year finishes out. I think it finishes out, say, here or slightly higher. We go into next year, if earnings stay where they're at, I think, then you can get that normalized. I think you probably, don't have the expectations of a 25% year, but you can have that
Right.
high single digits, low double digits, say that 8 to 12, which again, for your clients and how you plan, that's a nice return.
Right. And of course, that's kind of what our expectation was for this year.
That was
Really.
mine for sure.
Right.
And the part of the
Yeah.
reason that it's been better is the earnings been better, like I said. And I think,
Right.
you know, the tariff situation, I think people thought it was economic chaos. Now it's more art of the deal. Hasn't necessarily impacted the overall economy yet, and there's potentially some signs of some good things coming from it. We'll see. That tariff issue is still unresolved, so that
Mhm.
we still got to keep an eye on that because tariffs ultimately are a tax. There's
Mhm.
no doubt
Right.
about it. It's a matter of where the tax falls on it. It's three
Mhm.
different parties. It could either be the exporter, the foreign companies and governments and then when it actually gets paid, when it comes into the country, those tariffs at at customs, then the U.S. company importing them pays
Right.
the tariff, and then they hopefully either it got passed on from the exporter, importer, and then ultimately could get passed on to the consumer.
Right.
And so if we get too much of it gets passed on to consumer, that's a little bit of a headwind. And you hear me anytime I talk about in any of these shows, it's like no one can spend like the U.S. consumer. So unemployment, as long as they're working, people have money in their pocket, they will spend, and that's what we're seeing right now.
So it's a consumer-driven market.
It's 100%.
Our economy is all consumer-driven.
Yeah,
so
the GDP is about 70% driven by consumer spend. So that's something to keep an eye on. You know, one thing I haven't talked about is the labor market's getting a little bit soft. We've seen signs on that. So that's another thing, you know. So it's not all, you know, I'm laying out a lot of the positives, but there's some negatives that are some potential headwinds that we have to keep an eye on, which leads me to think that next year will be that more that normalized. I think unemployment's kind of sneaking up a little bit. We're at 4.3. Now with this government shutdown, we're not getting data. I think it's roughly around that 4.3. I think it does go a little higher, you know, end of this year, going into next year. But the 25-year median average is like 5.1%. So if we stay at, you know, 4.3, 4.4, 4.6, I think we're fine. You creep towards 5, I think then investors all get a little bit more nervous. We're not there yet.
Yeah. Do you think, Keith, that the numbers in the labor market are a little bit skewed right now with the fact that we've had basically 1 million deportations, either deportations or self-deportations? It's affected those numbers, right?
Yeah, 100%. So I think that's, you know, I think by those jobs leaving or however they're coming, that's kind of taking off that bottom part of the labor source that now that we have to backfill that. And so, but you're seeing some of this AI displacement as well. You just on the front end of, you know, artificial intelligence. I mean, we're going on a lot of different subjects here, but artificial intelligence, right? I mean, that's kind of touching the labor market, and you start seeing certain jobs. I'm telling Tony the other day, you know, I got 3 kids in college. I certainly wouldn't want them to go into anything like a call center. I don't think that, you know, that's something I can replace. Things like that, you know, technical writing, whereas, you know, I just was writing up my monthly piece of my thoughts for October. I normally write it up, pass it on to one of the other portfolio managers who corrects it for maybe an hour, hour and a half, 2 hours, whatever it takes, and then get it back. And the whole process. Now I write it up, I could throw it through an editor, and it comes back, and so that's wonderful. And it literally takes like minutes, you know. So it's time efficiencies. But if you are a person that works on an editor, I certainly wouldn't want to be there either. So I mean, your point about those jobs and, you know, going away, those 1 million jobs, there'll be some people that maybe were displaced in other things that can maybe backfill some of those jobs that we're losing some labor force.
I mean, we have copywriters who work here in the office and work on scripts. And George, our poor copywriter, when I see him walk through the halls now, there's this huge, tall, 7-foot guy in a black robe with a sickle just following him. I'm like, and it's like on the back of the robe, it says Chat GPT. No, I kid, but you know, there are certain jobs. I mean, copywriting is already basically done. I mean,
and it's so easy, and they do a wonderful job. So, I mean, that's what all the stuff we're talking about goes hand in hand with the economy, labor, unemployment, earnings. And that's what, you know, me as a portfolio manager, I have to take all these different inputs and decide kind of where we want to allocate the money. And then I work with, you guys are fantastic to work with. And we kind of say, okay, you know, I have a client that, you know, is a balanced client. How do we allocate them with all the things that you're seeing? This is what we see on our end. And then we kind of work as a partnership. It's great to do that.
So I just wanted to ask, you know, of course, we're talking about the labor market and a little bit of softening there. Any other negatives, you know, that you want to bring up here? Because I know we were talking about some of the positives. And, you know, in any market, there's both, you know, positives and negatives, and it's the balance and how things work back and forth. Any other negatives you want to bring up?
Yeah. So we're keeping a close eye on the labor market situation again. So we're not flying a little bit blind. Same with the Fed when they did their 25
the government shutdown couldn't have helped the labor market situation either.
No,
that has to add to those numbers, right? I mean, I don't mean to interject, but
yeah, that's part of it. I mean, typically investors have, you know, this market, I think the month of October, the whole month of shutdown, I think the S&P is up over 2%. So investors are looking through it. And generally speaking, I'll throw a quick stats there is they're short. They're 8 days on average. We've had 22 since 1976. So they're not uncommon. You know, every few years you have them for whatever reason, but they're generally short. And the reason that investors generally look through them because they're 8 days on average, and the longest one was 35 days. So we're approaching that right now. And the other thing is, you know, generally when those furloughed employees, they get called back, they get back pay. So there's some question if that's going to happen, or if some of those furloughed become laid off and don't come back. And now we're approaching 35 days. So there's concerns there. Other just overriding concern, which is lower on my list, is valuation, what you pay for stocks going forward. The market's, if anybody tells you the market's cheap, it's not. The reason
Right.
it's more expensive is because of those earnings growth that we talked about earlier. We're at 10% this year, 13% next year. That allows your multiple. One way of looking at a multiple, what you pay for the market's a PE multiple, price to earnings. So that's at about 22 times forward PE. Just put that in perspective, like the 10-year average is around 18. The 5-year average is around 19. So we're at 22. So that's a little bit of a fear. Those are some of the things that we're keeping on. The labor is definitely one. Valuation's another one. The other one that you're seeing signs is, I think, if we look back to 2025 in 5 years, 2025, or we'll look in 5 years from now, if we look back to 2025, it's going to be remembered for the tariffs for sure. That's going to be kind of, I think those are here to stay, by the way, even next administration, whoever it is. I think it's a new source of funds for the government, so that's going to stay. So certainly remember for that. And the other thing that's going to be remembered for is artificial intelligence. That's been a huge driver for all these earnings that we're talking about in the stock market. So there, at some point in time, the law of large numbers, I think that slows. I think there was an example this week with earnings generally really good on those big tech names, but Meta, they reported this week and their CapEx really stepped up, and it's finally the market had a negative reaction, at least a couple of days of too much CapEx. That means there's too much spending on AI with without some of those revenue returns. That's the first time we've seen that. So this could be the tip of the iceberg saying, all right, guys, AI is fantastic. It's going to change the world, but let's see some more revenue for the step up function CapEx, which could then put a little bit of a governor on those top 10 names we talked about earlier, which is 40% of the market, which could at least maybe, I think they still perform, but maybe stall them out or don't perform as well as they have in the last 2 years.
Sure.
Keith, I've had a number of clients, or two or three different clients, mention to me their concern about the AI boom and the crypto boom being too similar to like the .com issues we had back in 2000. What's your thoughts on that?
Yeah, I would say, again, I'll date myself. I was started before 2000, so 2000 was terrible. And part of the reason I think it's different, and maybe a little similar, but it's different. The difference is, these large cap tech companies that are driving the market, they're growing fast and they're cash flowing. They're huge. Whereas back in the tech bubble, a lot of those companies didn't have earnings. These companies have earnings. They have real cash flow. And by the way, back then, the valuation on like a Cisco, for example, was like a 200 times forward PE.
Oh, wow.
Those mega cap names I just mentioned, they're at around anywhere from 20 to 35. Not cheap, but not 200.
Right.
They have a lot of cash flow. They have a lot of earnings. So I think that's the biggest difference. And sure, yeah, we could have a pullback of corrections are normal. We could have a correction of 10%, and then those valuations go from 30 down to 25 or something like that.
I want to say something you said there. I want to clarify that because I think that's so important. You hear, is this another .com bubble crash? Like you guys were saying, Jim and Josh, but you nailed it. In the .com, I mean, I lived through that and saw that happening as well. And those were companies that really had overextended themselves and got all these venture capital people to invest and all these investors to give money because everybody wanted to be part of the .com craze and everybody wanted to have the hottest website, but they weren't producing anything and they didn't have earnings. So they were spending millions and sometimes billions of dollars, hundreds of millions, and a number of companies. I mean, we're talking about thousands of companies spending hundreds of millions of dollars each and not having any actual profits for extended period of time, and that's not sustainable. With AI, these companies like that, it's helped Nvidia, but Nvidia has profits.
Oh yeah, huge,
huge profits.
Didn't they just set a record for the highest value,
$5 trillion.
They're a $5 trillion company. I mean, that's crazy.
And they're doing billions and billions of dollars of revenue a quarter, whereas those names that Tony, you and I lived through, it's like pets.com, for example. There was no business model. Anytime you threw a .com on something, it just investors are chasing
Pets.com, that's going to be huge.
And there ended up being some lot of losers in there, but there end up being some real companies in there. I think the difference now
Amazon.
is, yeah,
I mean,
right? That was back then.
obviously Google,
those are just
Amazon.
they were back just selling books back then. It's
Yeah,
crazy how
we know the
transformed.
winners. We know
Right.
the winners, but there are very few. Like
There
you
was
can
few.
count them on one hand
Yeah.
when there were thousands of .com.
Right.
Yeah, and I think that's the biggest difference is these guys have real business models that are actually cash flowing currently, and if things do slow down, they can cut those back, and their growth rates will slow, so then their multiples may go down, but they're not where you're not making anything.
Plus, we're talking about tangible compute. AI is really computers and computing,
Right.
and .com is a website. It's not the same.
Yeah.
Right.
You can't website finances and somebody who is making chips for AI or servers for AI or being able to do jobs for companies. It's just I agree. It's a whole different ball game.
Yeah.
It is.
But, I mean, it's had a nice run up, so that's why people like to compare. And I don't. So I do think they're a little similar, but I think there's a lot more real and sustainable. Now, that doesn't mean we can't have a correction on top of it. I don't see the situation in 2000.
Yeah, you don't see the potential for a 40% like drawdown like we had in the 2001 because, as you just mentioned, these companies have some profit, and so many of those. I remember those. That's when I was just getting started in my investing life, and I remember seeing some of these companies. I'm like, well, you don't have any profits. You don't have any profits. Your stock price is going like crazy, but there's nothing to back any of this up.
Yeah, no, it was. I tell you how from an institutional investor, what was happening? It was like fear of missing out. All these IPOs were coming to the market.
Yep.
We used to see, the company I used to work for, you literally would go see. Normally, you'd have one a month in a normal cadence. They were bringing like 5 a day, and you couldn't have time to send your staff to see them. And then there'd be a report saying, "Oh, this is a 5-bagger on these gold." There's this one person that published this IPO thing. It's like, "Oh, it's got to be 5-bagger. I haven't done any research. It's got to be good. Give me an allocation." And it was just people just chasing stuff. And it was actually very silly. Where this is nothing like that from the inside, the baseball kind of perspective.
Yeah, but nobody has a crystal ball. I mean, the AI bubble could burst a little bit and see a major correction if something's overvalued. I mean, $5 trillion in Nvidia, maybe the company is overvalued.
Yeah, and that's the one thing that like I said, a correction or even a pullback is possible, especially if you just remembered not too long ago was DeepSeek from China came out, and those names, kind of those tech names we were just talking about, they got hit pretty aggressively in spring. And it's just like I do think at some point in time something like that changes the AI dynamic of we're still investing in those companies, we still like them, but I'm very attuned to something changing there where a competitive environment changes. Like right now, one of the things that problem with AI is the amount of energy they consume.
Yeah,
it's crazy.
Server farms and electricity,
which drives up the consumer prices, which is just it's a net negative for the consumer with money in their pockets. That's a drag on that. But if something like DeepSeek comes out and does it cheaper, less energy, I think that could that certainly have a material impact on like a Nvidia per se, that's leader in the AI space. But then a lot of other companies that use AI would benefit. So there could be some. That's where I'm always watching to see where the ball and the puck's going.
Yeah.
Yep. Nice. So I mean, we've talked about a lot of stuff, and there's still so many things. We don't know what's going to happen with the government yet, and we still don't know what's going to happen with the tariffs and exactly how that's going to play out. I mean, the market obviously, saw that pretty negatively initially, and it seems like they're taking a little less severe stance on the tariffs. But like you said, Keith, we still have time before we really see how it plays out. And so looking forward, I mean, we still have this fourth quarter coming up. What do we see happening in anything you see on the wings, close up in this fourth quarter here before we hit the end of the year?
So what we look at, obviously this Q3 earnings reports, we're around 2/3 of the way through. It's been really good. It's been better expectations. And then generally speaking, those companies guide out one quarter, which would be the Q4. And they've been better than what people anticipate. And the other thing, this tariff thing that it's been a whole story of 2025, and I think it will be remembered as that. There's not a whole lot of companies. There's a few that are calling them out. There's individual companies, especially if you're some consumer related, that maybe you imported some retail, from China that has now got a 50, 70, 100% tariff on that you can't pass on to your consumer. A few companies are getting impacted, but as a whole, you're not seeing it, at least in the earnings calls, and they're talking about it. But most of them, like, your Walmarts and some of those names, Costco's, they're generally eating some of that cost. You remember the three parties of, the exporter, and they're pushing back a lot on the exporters, definitely eating some of their costs. The importer is, and they're passing some. So again, if it's a split, a third, it's not horrible for the consumer. Where the bad case would be is if it got pushed about, 80, 90% onto the consumer. That would be a scenario which is not good. So that's what we're keeping an eye on. And then we can, talk about tariffs a little bit. I think, my point earlier, I think tariffs are here to stay. Even if you like them, don't like them, it's a newfound revenue source for the government. Here's some stats I'll throw out for you guys. Is if you go back 100 years, we call it an effective tariff rate was at about 20%. That's when there was no income tax. That's how the government kind of raised a good chunk of their money. You had globalization, free markets. It went from that 20% for the next 100 years, 90 years, down to about 1.5%. Tariffs, we never talk about it here in the U.S. It wasn't, outside of the U.S. story. They would tariff us. We wouldn't tariff them. Who knows what's going on? The U.S. citizens generally didn't care. And so now the tariffs, back in 18 and 19, Trump came in with tariffs and basically raised it for 10% in China.
Yeah. Well, guys, we're almost out of time here. Is there anything else you have for Keith before we go?
Keith, just one last question regarding the Fed lowering the interest rates. We thought it was interesting that there was kind of a dissenting of opinion within the Fed. Quick comment on that.
Yeah, I mean, the probability that the Fed cut was like 99.9%. Shocker. They cut 25 basis points. Now, the problem going forward, the next meeting is in December, 6 weeks. If the government stays shut down, there's no government data, so the Fed's kind of flying blind there. So that's, history is kind of what just happened, what we care and what your clients care about, what's going to happen going forward. It's about a 75% probability they cut another 25 basis points. I'm a little more indifferent. I think I'd rather have them hold it off and not cut if the economy is strong enough to handle it. If the job market's starting to weaken a little bit more, then I say cut. But if it stays around where it's at, I think they don't need to cut. So I'm a little bit against consensus that way. And I think if you go into next year, I guess that's what we really care about when you look at a full year. Markets are expecting about 100 basis point cuts. I think we can do 50 to 75, maybe 100. I think that's reasonable. So that should be generally a tailwind for investors. Now, for your clients that are retired, just because they're lowering rates, that spurs the economy. Lower rates are not necessarily as good. That kind of that green money, the savings account money. Right. Investors just should expect to earn less on that as the Fed cuts.
Sure, absolutely.
All right. Well, this has been a great show. Some eye-opening, great information. Great to have somebody really a specialist in the field, a senior portfolio manager from Gradient Investments here, Keith Gangl, and Josh and Jim. Great show, great questions today. Before we go, let our listeners know how they can get a hold of you.
Sure, Tony. Easy clients, just give us a call, 417-641-3497. And don't forget to check out our website at latourasset.com.
All right. And that does it for today's episode of LaTour Retirement Talk with our hosts, Jim Margraf and Josh LaTour, and our special guest today, Keith Gangl.